This is bad. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Target just dropped a bombshell as they said the unthinkable is about to happen. I'll show you why what's coming for Target is going to negatively impact every major retailer. This is an ominous warning for the entire U.S. economy. And we're seeing panic from political elites all around the country. That is, except for the United States. Is the Fed on the wrong side of the trade? I'll show you why they are. And is there a sign that we could see a flash crash in U.S. equities as a time when everybody's all in? I'll show you a major warning sign that says we could be on the edge of a major correction. Plus, we have a sponsor for today's show. I'd like to welcome DevStream Holdings to the show. You can find them on the CBOECA under symbol DESG and on the OTCQB under symbol DSTRF. They're a leader in green project investment and carbon credit generation. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over where we picked today's story up with a headline, as consumers are running out of money. This from a former Target executive who offers a dire warning ahead of the Christmas season. It's very clear that consumers are running out of money. They're increasingly stressed by inflation and the exhaustion of their pandemic era savings. And this is something we've been warning about on the show, that despite the fact that total income growth is relatively high historically, there's evidence that consumers are just cash strapped in every possible way. And when this happens, well, it means spending is about to plunge, unemployment's about to rise, and the U.S. economy, as you're about to see, likely to head into a recession. And when you take a look at the last several years, what you see month after month, he says, is everyone talks about the consumer still spending. They might be, but they're spending less than the growth of inflation. And this is something that's been going on for the last 2 years as we see advanced resale sales that are adjusted for inflation, or what's called real retail sales. They've been negative for the past 2 years. And we continue to hear, particularly from small businesses, that they're cash crunched because consumers are coming in looking for a deal. And if they don't find it, they're heading out the door. And this is a major problem because at some point, retail sales are going to plunge, and we're going to find out that the labor market that everybody said is strong and robust is nowhere near as good as it claims. And here we can see advanced retail sales at less the consumer price index, or real retail sales in blue, against total income, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That in red, and they're both on a year-over-year rate of change. Now, what I want you to see here is total incomes historically are well above the norm, and this is everything to do with pandemic stimulus, but look at how it comes down. And despite the fact that it's well above trend, notice how real retail sales crashed right around 2022 and have stayed negative nearly the entire time. And so this puts the question is, what are consumers doing with their income? Why aren't they spending more? Well, it has everything to do with their savings, because when we take a look at the personal savings rate against total incomes, well, we notice something very interesting. First, we see that total incomes slow down and crash heading into a recession. At the same time, the personal savings rate, shown in blue, rises going into recession. And so what this indicates is that consumers, seeing that the economy is slowing down, they start to save more. Now, one of the challenges with the personal savings rate, it doesn't just mean that people are putting cash in a bank account. It means they could be going out and buying stocks or real estate or other forms of investments. But nevertheless, what we see here is a trend that when incomes start to slow down, consumers see the economy falling apart and they start to realize that they don't have a savings buffer and start to build that up. Now, look at what we see right around 2022. You see the personal savings rate gets to nearly a historic low, and then ever since then, consumers start saving money at a time where their income growth is slowing. Now, one of the possibilities here, it could be going into the U.S. equity market, and in a big way, but nevertheless, the problem for retailers here is that consumers would rather save than spend, and at some point, that leads to entirely a big unwind of the U.S. labor market. And as we head into the holiday season, where everyone is expecting to see a strong and robust consumer come out and spend, well, this former Target executive is saying that's not likely the case. And when asked about his forecast on the upcoming spending season between Black Friday and Christmas, the former Target exec said, "I don't expect much, frankly, and I think that if we can get growth in the 2.5% range, that we'd be doing pretty well, and that's not very good. In the heydays there, well, we'd really want to see something that's more like a 4% type growth. You have, by the way, the shortest holiday season you can even imagine, so that's against retailers as well. And remember, if retailers don't hit their numbers, if they don't get enough money in the store, what's going to happen is they're going to be forced to lay off. We see this event happen over and over again. Besides Target, he was also the former CEO of Toys R Us, and he noted, now in this time between Thanksgiving and Christmas is very, very short, so that's going to be bad. The election is going to weigh on things and the geopolitical situation as well. So I think it's going to be a pretty weak Christmas, and this is a dangerous sign for the entire retail space, because right now, what have we seen? A mass amount of imports coming into the U.S. on the hopes that U.S. consumers are going to come out and spend big in validation that not only the election's over, but we're experiencing the mythical soft landing that the Fed's promised us. So what we need to see from retailers is all this inventory get moved off the shelf at higher prices, the inventory then move out of retailers. And if this doesn't happen, and I don't think it's going to, what it suggests is headed into the first of the year, retailers and wholesalers and manufacturers all around the world are going to be laying off in a big way. And we get some evidence of that as we look at real retail sales, again, still shown in blue on a year-over-year rate change. You can see unemployment rate shown in red, and what do we see? Slowdowns in real retail sales lead to an increase in the unemployment rate. Of course, you could look at it the other way and say, wait a minute, maybe it's the economy slowing down, people starting to get on unemployment, and when they do, they have less money to spend, and that's why real retail sales fall. We can make the case both ways because you can see they go virtually in lockstep with each other. And now we go back to 2022. Over the last 2 years, we know consumers were saving more. Again, they could be just investing in the stock market, but nevertheless, they're not outspending money, which is a dangerous sign for the economy. We see 2 years of negative real retail sales against now a slowly rising unemployment rate. And again, if these retailers do not hit big numbers in this holiday season, they're going to be forced to lay off in the beginning of the year. The longtime retail executive's ominous warning about consumers stalling this holiday season comes after retail sales showed consumers increased their purchases at retailers last month. However, this is only because of higher prices. In other words, consumers are spending more but receiving less. And that's, again, why we look at real retail sales, because it gives us the true picture here. Investors are looking at the equity market saying, wait a minute, retail sales are up, consumers are spending more. But as we get into earnings season here, and remember, this is the biggest week for earnings, what we're likely to find out is this not driving the big profit margin that everybody's hoped. And the outlook for the holiday season comes after Goldman analysts noted that the trade down phenomenon has rippled across high-end and low-end consumers. The last time trading down mentioned soared on earnings call, get this, was during the global financial crisis in 2008, suggesting that this holiday season could be the beginning phase of us heading right into another financial crisis. But again, it's not only Target that's facing issues. As we look at Procter & Gamble, who reports weak sales growth on lower beauty demand. So again, we see the same thing happening across the economy. Demand's going down. Production at factories still remains relatively high. Inventory levels are building all across from retailers, wholesalers, and manufacturers. At some point, the music stops on this, and the weakness is mostly relegated to the Middle East and China, suggesting that perhaps everything's okay with the United States. But keep in mind, China is the world's largest exporter. So when demand goes down in the U.S., they put in fewer factory orders. That's why we see slowdowns in China happen before anywhere else. The problem is, everyone thinks it's just a Chinese problem. The reality is it's a sign that the U.S. economy is weakening and fast. Management did not call any new red flags amidst a backdrop of increasing concern around consumer growth. But look for a big disappointment this holiday season, and they're going to be flying more red flags than you can count. Because we even see issues in the tech industry as ASML CEO sees slow chip recovery extending well into 2025. And remember, AI was supposed to save everything. It was going to drive massive profits at tech companies. It was going to help everybody. It was going to drive huge earnings. And what are we seeing? All it is a fancy chatbot that nobody can actually figure out what to do with, and everyone is scrambling to justify billions of investments, which is now why we're seeing companies like ASML start to raise massive red flags. as ASML is facing one of the most turbulent periods in the company's history. The Dutch company, which makes the world's most advanced chip-making machines, has shed over $65 billion in value since it reported bookings that were less than half of what analysts expected on Tuesday. So there you see again, issues with demand coming down. So all this AI hype is not coming into fruition. That's what we're going to be finding out in the earnings season here. Companies are going to have to justify the spend here. They're going to look to cover it up in the hopes that sometime in the next year they've got an answer for investors, because they're looking to drive the stock market higher at a time when companies may have overspent again on some technology that's not ready for prime time. And today, without AI, the market would be very sad if you ask me, suggesting that the only reason people are buying these machines is to make chips for the AI market. The recovery is not what I think everyone had wished for, and if AI doesn't turn out to transform the world, we'll look for demand for chips and tech companies to absolutely plunge. And this is why we're seeing, of course, political elites all around the world start to make changes as panic sets in. But is the Fed behind the curve? Well, as always, they are. As Chinese banks slash lending rates to bolster ailing economy. China's top leaders in a September Politburo meeting called for substantial cuts to interest rates and measures to stop the property market from declining further, their strongest vow yet to stabilize the crucial industry. And yet we all hear about how wonderful rate cuts are and how it stimulates the economy, injects money into the economy, and that all of a sudden we're going to see a robust demand out of China. But yet, as I've suggested, all the stimulus China's done hasn't worked, and there's no signs that a rate cut will work. Because when you think about China, again, they're the world's largest exporter. When demand from around the world goes down, well, that means Chinese factories start to slow down, and workers there start to see these signs and realize that their incomes and their jobs can be at risk, and they stop spending. But yet China thinks, well, hey, rate cuts will solve everything. But in a booming economy, this would actually work, because what a rate cut does is it pulls forward demand. So if there were people that wanted to buy a house or borrow money that just needed a little bit of their payment to come down, this would work. But in a slowing economy, it never worked. The larger than expected LPR cuts are meant to contribute to the stabilization of the property market, and yet, as I predict, they will not work at all. The PBOC has signaled more easing is on the cards because, again, they're just admitting that the rate cuts aren't going to work. And I want you to see this. If they did work, then what they would say is, hey, we just cut rates and everything's going to be okay. Instead, they're saying there's going to be more cuts. And if that's the case, why don't they just cut some more now? And Pan reiterated on Friday that the central bank may lower the reserve requirement ratio with frees up cash for banks to lend by another 25 to 50 basis points by the end of the year based on liquidity situation. So again, they're trying to pass up that maybe there's some liquidity issues of the banks, which is why, of course, we need to issue debt and inject cash into the banking system. But I want you to see what's the truth here, because they cut rates in the hopes that consumers and businesses will spend. But they don't know that that's going to happen. In fact, they believe it won't, because they said there's going to be more of their rate cuts in the future. So if that's the case, then what do they think the problem then is? Maybe it's with the banking system. And they think, well, perhaps the banks don't want to lend, so we're going to lower the reserve ratio to encourage them to lend more money out into the economy. Again, it goes to show that these political elites, no matter where they are in China, in Europe, or the US, they have no clue how things work. And in this case, what we see is China scrambling to save their economy with things that won't work. As far as interest rates, many expect the PBOC to only reduce them again next year after the recent outsized cut. That is, except me, I think they're going to be cutting a whole lot more. However, if there is a major negative shock to growth in financial markets, then the PBOC could be more aggressive in its easing to counter such shocks. So again, here you see, of course, experts come out and already tell people if this doesn't work and things get worse, they could do a whole lot more. And all that's suggesting is what we already know is rate cuts and reserve requirement reductions will not have any impact on China's economy. They're about to plunge into a recession, and that means the PBOC is going to slash rates, and with them, so is the ECB. And don't worry, the Fed will follow. As Simca says, it's clear that the rates will be lowered further. And he reiterated that concerns about the labor market, saying layoffs could drive inflation, quote, significantly below target. And this is something that we've said is likely to happen, that we see the real relationship between consumer prices is the labor market, because when people lose their job and they go on unemployment, they have less money to spend, so they have to cut their spending. It only makes perfect sense when they cut their spending. Well, as we already see, retailers have seen negative real retail sales for 2 years, it means that's going to plunge and more people are going to lose their job. Because once this starts, once we see the labor market start to fall apart, it's all downhill, and inflation isn't an issue. Because in base cases, the policymakers will still engineer a soft landing without a sharp rise in unemployment. Well, good luck with that. The Fed has never achieved that. In fact, to my knowledge, no central bank in history has ever achieved it. Because as we look at the consumer price index against the unemployment rate in red, what do we see? As consumers lose their job, well, inflation becomes a foregone conclusion as it turns into disinflation. During the global financial crisis, it turned into outright deflation. And right now, despite the Fed's claim that the labor market isn't going to unwind anymore and that we're on track to hit the 2% target and hold it, my view is we're going to blast right through 2% and continue down. The labor market's going to come unwound as well, and the Fed's going to be cutting rates all the way back to zero. But if you ask them today, that's not going to happen, because Fed's Logan repeats call to lower rates, although gradually, because once again, they believe that the power of interest rates are going to work on American consumers. But again, we go back to China. What's happening there? Demand is going down at the factory level. And why is that? Because U.S. consumers are spending less. It only makes perfect sense. Because if the economy evolves as I currently expect, a strategy of gradually lowering the policy rate toward a more normal or neutral level can help manage the risks and achieve our goals. However, any number of shocks. So again, here we go back to China. What do we see the experts saying? Hey, they're cutting rates and they're not going to have to cut rates a whole lot more. But if there's a shock, they're going to cut rates a lot. And then look at what we hear from the Fed. They say the exact same thing. However, if any number of shocks can influence what that path to normal would look like, how fast policy should move, and where rates should settle. So once again, the Fed is setting people up to say, look, we're cutting rates. We think this is going to work. At least that's what we're telling you. But if it doesn't work and there's a huge shock, we're going to be slashing rates. The problem is investors say that's not going to happen. We've got the soft landing. Everything's going to be okay. But there is a major red flag. It's called the dollar. As JP Morgan figures show surging dollar demand as U.S. election nears, and this is a risk because the dollar is surging higher here, and that means, of course, there's likely to be a dollar shortage building in the system. When that happens, when we see rapid moves in the dollar, it means we're on the edge of liquidity crisis, could generate a massive air pocket into U.S. equities at a time, as we talked about in yesterday's show, everybody is all in. But something that we think is going to boom is a stock for our sponsor for today's show, DevStream Holdings, as demand for carbon credit generation surges. You can find them on the CBOECA under symbol DESG and on the OTCQB under symbol DSTRF. All the information in the pinned comment and description below, because DevStream is a leader in green project investment and carbon credit generation. And this is a $1 trillion market already, as carbon credits are a financial tool designed to help organizations advance decarbonization efforts by funding environmentally conscious projects. The carbon market is approximately already a $1 trillion market, expected to more than double over the next 4 years, which DevStream Holdings is positioned to take advantage of. And there's nature-based solutions and there's technology-based solutions. And DevStream is a leading carbon credit company focused on technology-based solutions, which leverages innovative technologies and capital to further avoid and reduce carbon emissions. There's a limited number of players in the space. It addresses many of the issues that currently exist in the carbon market and has a potential solution to provide 80+% of carbon emission reductions needed to keep global warming below the 2 degrees Celsius target by 2050. The 3 pillars of DevStream's business model are environmental asset generation, environmental asset management, and industry consolidation platform. They have a scalable and defensible approach, as the DevStream COP method has unlimited number of activities, multiple locations, multiple project owners, with development costs in the $75,000 to $150,000 range and annual maintenance costs in $25,000 to $60,000 range. DevStream has a large and diversified pipeline with an opportunity right now to generate 30 million of credits per year, with the potential to hit 450 million plus a year across 140 projects. And their large-scale carbon offset programs are expected to serve as drivers of long-term growth, with EV charging carbon offset programs, building and facilities carbon offset programs, industrial facilities energy efficiency carbon offset programs, and international renewable energy certificates. And they've got a high-level financial profile, as the underlying assumptions of the company's financial projections can be found in its proxy statement. Here we see Calendar year revenue projections at 31.2 million for the end of 2024. And how about this at the end of 2025, 131.7 million, meaning that DevStream's holding stock is an absolute bargain here. You can find them on the CBOECA under symbol DESG and on the OTCQB under symbol DSTRF. And they just acquired 50% equity stake in carbon sequestration hub facility. Today, they announced the signing of an MOU whereby DevStream will acquire 50% equity stake in MSP and its carbon sequestration operation. In exchange for 50% equity stake in the facility, DevStream will issue 2 million newly authorized shares of common stock for the public company, resulting from its proposed business combination with focused impact to MSP. Upon closing of the business combination, NewCo is expected to be named DevStream Corp and begin trading on the NASDAQ under the new ticker symbol DEVS. And this proves their unique advantage in the industry, that they're the only ones that are public that will eventually be on the NASDAQ, and they're able to structure deals and acquire and merge assets such as carbon credits and projects for equities, making this a very unique investment opportunity with massive upside potential. But as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.